So we're gonna run this like a panel, an actual panel, as opposed to doing individual presentations, and I am expecting additional questions to come from the audience as we get going. So I'm going to introduce myself first for those of you who don't know me, although I feel like I probably know about 50% of you, if not more. My name's Meaghan Seagrave. I'm the Executive Director for Bioindustrial Innovation Canada. We commonly refer to it as BIC, a lot easier than the great long name. You can tell I work with a lot of engineers. Let's come up with long, complex titles for things. So we are a green chemistry accelerator. We're national in focus. We work cross-sectoral. We also work with a lot of you folks in terms of industry players and government officials. We try to build global companies that are changing the landscape around the bioeconomy and decarbonizing on an industrial scale. So let me first thank Jeff and the sponsors. Thanks for bringing us together to discuss Canada's bioeconomy opportunities while highlighting regional, national, and international collaboration and opportunities. I really like this event, as Jeff had mentioned, and as Jordan pointed out. It is the only national event that we have in Canada where we actually talk cross-sectorally about this, where we talk about the forestry opportunity, the ag opportunity. We sometimes miss a little bit on the marine and fisheries side of things, but this is industrial decarbonization and the resource endowment that we have to allow us to do that. So, focused on industrial decarbonization, we have three great panelists for you here today. I'm hoping that you'll see my vision in terms of connecting these wonderful folks. We've got Stuart Galloway, Executive Vice President of SOFIAC, who's furthest on my right. Derek Griffin in the middle, responsible for green tech solutions with Munich Re. And we've got Austen Hughes closest to me, Vice President for Project Finance with Natural Forces. Each of these organizations come at projects in a very unique fashion, from an investment, from a project building, as well as from an insurance perspective. So I'm going to ask each of them to do a quick introduction about their organization and to talk about how their organizations come at projects with regards to investment and de-risking around investment and insurance and globally de-risking for projects in the industrial bioeconomy. So I'll start off, I'll have Stuart start, I'll ask Derek to chime in, and then I'll ask Austen to chime in. And I've got a number of questions that I'm hoping we can get a conversation started, and I would like to receive some questions from the audience. So you've got a mic in hand? Great. I'm going to ask Stuart to kick off, tell you a little bit about SOFIAC and how their organization de-risks project investment.
Great, thank you, Meaghan, and lovely to meet everybody, and a few familiar faces in the room, which is great to see. I represent SOFIAC. I do have another colleague here, and we've got a banner outside, so there's the promo done. We approach this from a very different way, I think, in terms of perhaps most of the audience here. So we start off with looking at the demand side reduction. So we actually start off by looking at the facilities themselves and right-sizing the actual clean energy that is to supply that. So if we reduce all the consumption within the existing building and make that more economical, shall we say, affect their bottom line, make the savings on GHG, make the savings on energy, then it means when we're doing biomass, we're doing solar, whatever that might look like, it means that actually we're not overproducing either. Or we're opening up other opportunities for the client to do other things with that additional energy that they can potentially produce. We partner up with energy producers, and we can do that in different ways. But the way we do the project, it's unique to Canada, is that we actually pay for everything. So we do all the upfront payments, we do all the upfront studies, it's fully turnkey. And when we finished, we actually hand over 100% of the assets that we've developed over to the client. It's complicated when we look at long-term financing and how much we can actually reproduce or produce in terms of the savings to offset the clean energy production. And that's why we do the partnering up. So people that are familiar with energy as a service, we'll partner up with those. We'll do that ourselves if we need to. But the idea is that it's an all-encompassing package. We're seeing this more and more from the clients. No longer are they looking at changing a boiler or putting a few solar panels or a biomass facility. They want to do everything at once. And that's what we focus on, because that's where we really hit the big GHG, but it's also where we hit the maximum efficiencies. The last thing I'm just going to say is the way we structure it. So we've structured this, and this has been the game changer in Canada. We structure it in such a way that it doesn't hit their debt service cover ratio. So their ability to borrow money, or the way they now choose between investment opportunities. They can have their cake and they can eat it. So that's the whole idea, is that it's structured in such a way that they actually free up their money to continue business as normal. Typical projects, we're doing Calgary Airport, Montreal Airport, some pulp and paper, some ports. So a lot of stuff. There's nothing we can't touch, really. So I'll leave it at that. Thank you.
Thank you, Stuart. And thank you, Meaghan, for organizing the panel. And of course, thank you, Jeff, for having Munich Re on the podium here again. So I'm Derek Griffin. I work for Munich Re. If you haven't been to this conference before, you probably don't know who Munich Re is. So we are the world's largest global reinsurance company. And as I've said in previous years, climate change is the #1 reason for losses for the insurance company. Forest fires, flooding, hurricanes. And what we're doing across the entire company to really support the energy transition is not just on the insurance side. So just want to touch on some of our investment activities as well. We actually have a ventures arm, Munich Re Ventures, and they have a $150 million climate tech fund where they've invested into geothermal technologies, energy storage, CO2 electrolysis. And then we also have a capital assets management team as well. So if those looking for project investment, we do have a debt and equity project investment arm. We do about $2 billion per year in energy transition investments. We also have other climate initiatives in terms of, we have a tree trust program where we're investing into afforestation and reforestation in South America. So this is really just on the asset side. Now, on the liability side, where I work in is really supporting the bioeconomy, where we are providing technology performance insurance for first of kind and next of kind renewable energy transition technologies. And so we're very active in Canada, a lot of biomass to fuels and biomass other products, projects that we're working on that I'll talk about on this panel. But I just want to highlight, so while Munich Re is a traditionally insurance company, we're very active across the entire asset and liability program. And just a little connection over to SOFIAC, we also do have an energy efficiency insurance program as well. So for a lot of these biomass or even building system that are looking for energy efficiency savings, we actually have insurance programs if those savings are not realized. And then really forward-looking, hopefully something that will be more prevalent in Canada, we do also have tax credit and carbon credit insurance programs. Not just the regulated carbon credit programs, but also the voluntary carbon credit programs. So as these programs are hopefully become more prevalent in Canada, we'll be transitioning those types of programs that are currently offered in the US over to Canada as well. So thank you, Meaghan.
Awesome.
Okay, thank you for having me. My name's Austen. I'm the VP of Project Finance with Natural Forces. We would develop, own and operate wind and solar projects across the country. Recently opened a Dublin office in Ireland and also an office in France. I think one of the things that we do differently is the way we work with our community partners. The first 7 projects I worked on in Nova Scotia, they're all based and owned by the community, by the Nova Scotians. And then since then, we've done work with First Nation partners across the country. Excuse me. Our organization and industry has grown rapidly. I think when I first started the company, there were 416 megawatts of wind in Canada. Now there's about 15,000. There was 116,000 megawatts delivered last year alone, which is just crazy. So that's all I'd like to say on that one. Thank you.
So I don't know if you've been able to kind of see how my crazy brain weaves these things together, but in the bioeconomy, if we're approaching projects, we look at the engineering, we look at the techno-economic side, we look at citing these projects and moving forward. And then there's an understanding about who's going to de-risk this. Is government going to come in? Then are we going to banks for financing, et cetera, et cetera. So my BFFs here, up here on the stage, all come at these projects from really unique perspectives. They work a little bit differently, but they're all working in this larger bioeconomy, and I think we need to start to understand. We heard a lot about policy this morning on one of this morning's panels. We heard a lot about the opportunity from an international perspective with the Finnish delegation that's here. We need to start focusing on where there's opportunity to de-risk from a financial perspective and then a total project perspective. I put up this quick little chart here just to give you an understanding about, where SOFIAC is really about that financial de-risking. Natural forces is about the development of the project, construction of the project, operations, and then handing things over. And I'm going to ask Austen to elaborate a little bit on their First Nations expertise and relationships as well. And then you've got Munich Re, which is across the board. This is about technology performance. This is about de-risking first in kind from an insurance perspective. And then there's the investment piece as well. These are not individuals and companies that in the bioeconomy we typically, raise our hand and say, hey, can you help finance these projects? But they really should be. They need to be at the table. So I've got a few questions to get us started, and if you've got some questions from the floor, maybe just put up a card or a piece of paper and we'll have someone go around and bring them up. So in general, from your line of approach to project investment, what makes a project convert or be successful? And maybe I'll start with Austen and I'll go down.
I would say the caliber of the project. When we develop a project, we start with our finger in the air, trying to figure out if it's going to be a windy site, and then we carry it all the way through. We do great consultation, we do great stakeholder engagement. We work very closely with our First Nation partners, such that the partnership is a true equity partnership. And when we come to financing, so these projects are all project finance with partner equity and then senior debt. So once we get to that stage, it's a fully baked cake, it's ready to go, and we've mitigated all of the risks of development, and the lender will only come in once they're certain that there's no more risk. So I think the work that we do would be a big mitigator of success.
Awesome. Derek, in terms of Munich Re's approach to investment or de-risking on the insurance side of things, what makes a project successful?
I think we all know the general challenges, as was just mentioned by Austen. You need feedstock and offtake supply agreements, permitting, a well-developed project development team. It needs to be a well-baked project. A lot of the challenges that we see that I think the Canadian government could really support, one is development capital, right? We cannot actually get to a well-baked project if we don't get over the valley of death of these project development. And as we've been hearing in the last couple of years, the investment community is really shying away from development capital. And the banks are telling the developers that they need to go to their strategic investors. And so this is where I think some of the Canadian government agencies could really step in here. A lot of these small to medium-sized bioeconomy projects need, 5 to 20 million in development capital, and so this is where it's a big challenge. So, not trying to answer your question, since Austen already did a great job. Projects don't even get to a well-baked stage because they're really hung up in the development capital stage. So I just wanted to highlight that's one thing that I really think that could be supported from the government, not only just in the U.S. But also in Canada.
Thanks. So, Stuart, do you have anything to add in terms of what makes a project convert and then successful?
You know me, I've always got something to add. I don't think there's a simple answer to this because it depends on what's classed as successful. From our side, what converts a project is senior buy-in. So the ability to actually get straight into the C-suite and see that it's a commercial decision. It's not something that's based upon necessarily the sustainability officer or the facilities type person. It's actually a business decision because this is affecting the bottom line. What makes it successful, though, is when it becomes an all-encompassing project, rather than, when obviously they're looking at demand side, but rather than saying, I'm going to put a biofeeder in here and I think this is going to produce me a whole bunch of energy. Great. What does that actually mean at the other end? Is it too much, too little? I mean, I know there's issues around sort of where you get the supply stock, but actually, am I actually just building the right thing? And it needs to be an all-encompassing type solution. So that's what we would class as success. But obviously from success, it's also got to make sense. So our intention is to act, I don't know what this lady's doing for her. Have you got, do you want to say what it is you're doing with the bits of paper?
She's asking for questions. It's good.
Oh, right. Oh, okay. I didn't know that. I'm sorry. I thought it was a lottery or something going on there. I was like, anybody want to buy a lottery ticket? Yeah. So it has to be an all-encompassing type project, I think, that looks at everything as the round and makes it as a business commercial decision, not here we are, we've got a bit of money, let's put something in, let's change this. It's where am I going to go? Create my future, not solve the problem for today.
And I'd like to add one comment there, just on the financing. A lot of the projects that we see, the investors want to see these projects stood up on their own without reliance on credits. That is a big challenge. And so when you talk about bankability of projects, Stuart, most projects are only in the development stage because of these credits, but investors want to see bankable projects without. So I don't have the answer to that, but that's one thing that we see as a big challenge to getting projects to FID.
So you just highlighted something. What influencing factors or what trends, either or, are you seeing that are impacting your ability to de-risk or finance or insure? Why don't we start with you, Derek, and then I'll see if Austen will chime in.
Sure. So since I'm the insurance guy, I'll pivot a little bit. Right? We heard a lot about forest management, so I did want to make a saying from the insurance industry. Really, two big impacts that people are probably watching. Obviously, impacts of flooding. Right? We saw the major hurricanes in the U.S. $50 billion losses per Helene and Milton. Only 10% of that was insured. Right? The rest of it is borne by the taxpayers or individual losses. This is now happening in Canada as well, right? British Columbia and Ontario, most of the large cities are built in flood-prone zones, and we see what happened in the bomb cyclone last week. We saw what Toronto in the last few weeks. And so this is just a note. First, insurance premiums are increasing. Everybody knows the car and health insurance has gone up, right? That's not just inflation. This is also happening to your commercial bioeconomy projects. Property insurance is getting harder to place. It is no longer just a small line item in the financial model. These things need to be considered early on in project development. And then I also wanted to talk about project siting. So Jordan had a great point on trying to site projects in high-prone forest fire areas. Great, because then you can actually bring forest management to those areas and reduce the likelihood of forest fires. On the converse side, we have seen projects that move away from those due to the risk of their feedstock being burnt up. All right, if you saw the Red Rock project a few years ago, before the project went under, there was a major forest fire in Colorado, and the feedstock burnt up a year before the project was going to come on site. And so that's just on the forest fire. Also think about flooding. A lot of wheat straw is built in flood-prone zones, and you usually site your bioeconomy projects near the feedstock. So what we're seeing is that our projects moving towards the feedstock, but yet they're in flood-prone zones or in forest fire zones. So it's just a consideration that we're looking at and trying to de-risk this from the insurance perspective.
A lot of things that we don't necessarily think of, but they are becoming, as Derek said, line items on the financials. So Austen, what things are influencing or what trends are you seeing with regards to the projects that you're trying to stand up and de-risk?
Again, I think it just, is that on? Yeah. I think it just goes back to the way that we develop our sites, the way that we work with our First Nation partners. I think one of the things that's quite unique with our business is that, if you could imagine starting a business and making widgets, and you have a buyer for every widget that you would make for 25 years, that's a pretty strong business plan. And that's what we have with these off-taker agreements with the utility. We own the project, we sell the power to the utility, and they have to, by contract, buy every single unit of power that we produce for the 25 to 30 years. So that's quite compelling in itself. The warranties we have with the turbines generally match the term of the PPA to 25 years. Excuse me. The turbines that we use are called Enercon. Their warranty is such that if the wind turbine breaks down and they don't fix it, they have to pay us for the lost revenue we had have earned had they been operating. And the way that we pay Enercon for that contract is based on a per kilowatt hour basis. So if we're not producing, they're not getting paid and they're paying us. So it's like a double incentive to make sure that the turbines are up and running. And that, again, is something that we found for the lender's perspective. It's really interesting to know, really, really comforting to know that if the wind farm does break down, they're still getting paid their principal and interest back on the debt.
Awesome. So, Stuart, you're going to chime in?
I am. Yes, thank you. So a few things we're seeing. Obviously, there's the carbon credit and creation of carbon credits, and we're seeing more sophisticated use or sale, trading, and everything that's connected to that. We're also seeing a lot more now about the virtual power purchase agreement, VPPAs. There's a particularly large market happening in Alberta. All of these are creating better economics for some of the harder stuff that we see within projects. But one of the other aspects is ESG. I know it's been talked about, and we're always talking about ESG and the reporting and governance around ESG, but that's actually starting to become and actually I wouldn't mind Derek's view on this, but we're seeing this more coming from an insurance product type point of view. But we're also seeing it particularly coming out of the lenders. So if you've got a client that needs to do their core business and they're trying to raise money, ESG is now becoming a factor in that consideration when when they want to raise that money. So if you're raising money for, I don't know, some kind of power plant, wind, solar, whatever, and you have a lender saying, well, what's your ESG policy and how are you actually meeting that? Well, that is really starting to gain momentum, and a lot more clients now are getting concerned about that.
Yeah, so that's a great point. One thing that we've been getting a lot of inquiries on in the last 2 to 3 years, particularly with the potential SEC ruling in the United States. Actually, that's going to go away after the election. But anyways, ESG default insurance. So a lot of these corporates have whether it's voluntary or mandatory reporting requirements, if they default on their obligations, whether it's through their own fault, whether it's an executive fault, or they're just assumptions were incorrect. People are now looking for ESG default insurance, which is a new topic over the last few years.
Awesome. So I've got some great questions here. Some of them are exclusively directed at individuals here. So I'll start with this one since you've got the mic in hand, Derek. What technologies has Munich Re stopped insuring?
That is a good question. Technologies perspective, I wouldn't say there's a specific technology. There are emerging areas like direct air capture, carbon capture. Sequestration is very challenging at this point. So that's one thing that we are not active in, carbon dioxide sequestration, just due to the lack of the track record, and there's a lot of environmental and hazard potentials, right? I think it was reported this year that there was the first CO2 leakage plume. Right now, there weren't any deaths or any major hazards, but this is what investors are really concerned about, particularly from a reputation and liability perspective. So I wouldn't say that there's any technology that we haven't insured, but I do want to come back to talking about pulling out of insurance markets. The last comment I wanted to make was on this, again, flooding and forest fire. In Florida, all the insurers have pulled out of the flood insurance market, right? In Florida, homeowners can no longer buy flood insurance. Hopefully that does not happen in Canada. In California, forest fire insurance. It is extremely difficult to get homeowners forest fire insurance and also commercial property forest fire insurance, right? You have to do building with certain fire resistant materials. You have to do all sorts of vegetation management. The same thing is likely going to be happening to Canada. We haven't seen the trends happening in Canada yet, where it's very challenging to get these types of insurance programs. But I'll say Munich Re, not a technology perspective, we've pulled out of these markets. So I hate to say like the insurance is not enabling some of the energy transition. It's somewhat disenabling due to just the large loss impacts.
So this, I'm going to push this to Austen and then Stuart. And there's two questions here, but they're interrelated. So what rate of return are investors expecting, or what's the typical IRR that would make sense for bio-based or
From our side, I think the levered IRR somewhere between 10 to 15% will be what would be expected. Now we are seeing with all, so like I said, we've been working with our First Nation partners now since 2014. And we have been able to secure certain funding and grant programs for them. So obviously, side by side, the return will be the same for both partners. But when you roll in the grants that our First Nations have availed, then their returns would obviously go up as a consequence of the grants. So,
Stuart, rate of return, IRR, what's typical? What do you expect? What do you need?
Our rate of return or the clients?
The clients.
I'll go for ours because I've no idea about the clients. No, obviously from a client's point of view, it has to make sense, the investment that we are making, but the idea is we're making it risk-free. So it's quite a complicated calculation to show them a value for money complication. It's not just based on, I mean, it does spit out value for money at the end, but it obviously gives them an IRR. From our point of view, though, so we were sponsored under the Canada Infrastructure Bank. So that really helped us lower the expectations in terms of IRR and stacking other lenders in there, so bringing in equity and such. But our target IRR, because it doesn't mean we actually hit that, is at 8% for Fund 1. So it's a closed fund of 20 years, 5-year rollout. We had 500 million to spend in the first tranche to make it proof of concept. The next tranche we're going for is going to be 500 million to $1 billion, which will launch probably next summer, and it will reset back to 20 years. When we're booking projects for Fund 2 now, or because I'm a Montreal company, Fund 2, I don't know. I do non-French speaking Canada for a reason. I'm rubbish at French. But we are actually, we're capping it at this time at 11%. But we expect it to be lower because obviously interest rates are coming down. The more we pay in interest, because we borrow money, we don't lend money. That's how we're able to take that debt service cover ratio issue off the table for the client. So very complicated, explain it another time. But we're capping it at 11% as the internal rate of return on the fund. So it's really, really low below market.
Appreciate that. So I'm going to direct this question to Austen, just because you talked about opening up new offices abroad. And I guess Derek and Munich Re, because you're multinational, and maybe Stuart, I'll ask you to chime in just because your accent is clearly from someplace else. So what are the unique challenges that you've come across in Canada as compared to other regions where you actually do business?
I would think Canada's probably easier to do business than it would be in Europe. I think the policy that we have here is very progressive for renewables. I think what we found when I started in 2006, I was employee number 4, and now we have almost 100. And we've been fortunate to develop in Ontario and Nova Scotia and BC. So we found the regulatory environment quite supportive of what we've done. I know in England, for example, there hasn't been any onshore wind development now for many years because the red tape is such that you just can't get things permitted. The offshore is kind of gangbusters over there. There's still development going on in Scotland and in Wales, but certainly in England, there hasn't been any development onshore, which is crazy, really. High population density. So yeah, but I think generally speaking, we found developing in Canada certainly very favourable. Yeah.
Awesome. So Derek, what challenges have you seen across Canada compared to other regions where Munich Re operates?
Yeah, I'll say before the election, after the IRA was passed, we saw a lot of projects just get up and move across the border. bioeconomy projects where they would be trying to capture the ITCs in North Dakota, Washington, and these things. And that's not a challenge of doing business in Canada, but I'll say the regulatory uncertainty is probably even just as challenging in Canada as it is in the US. I would say a nationwide LCFS program would really prop up a lot of projects. A lot of our projects are in British Columbia just due to the BC LCFS. And so I'll say regulatory uncertainty and intermittent carbon credit programs. I'm a favor of the carrot and the stick, to be honest, right? The US only favors the carrot, Europe only the stick. Canada has a mix of both, so what I would really like to promote, obviously, is not just a nationwide carbon tax, but also a nationwide credit. So I think that would be something that would really promote some of the projects, bioeconomy projects for us in Canada.
Isn't that very Canadian of us? I'm sorry, but we'll give you a little bit here and we'll take a little bit away there. Got to make everybody happy. Stuart, realizing that SOFIAC just operates here in Canada, but what do you think some of the challenges are? Yeah.
Actually, we don't just operate in Canada. Yeah, we're in France as well. So funnily enough, we do have the European comparison, and I like Derek's point about the carrot and the stick, because I think we prefer more stick, because in France we're doing very well, because obviously with Ukraine and everything that's happening out there's a lot of stick at the moment to reduce consumption and make things more efficient. Over here, it's actually quite weird, because I used to have it written up on my book, and I'd say to a client, I know what you're about to say, it seems too good to be true. And I think we have a natural skepticism to good things or new things in Canada, which makes it very difficult to adopt something new. And obviously the SOFIAC approach in Canada is new, and it's gaining momentum. And 2.5 years ago when we launched, it was a harder conversation. It was trust me. And now, we can say airports and IBM and schools, colleges, whatever. We actually have projects to point to. So that conversation is becoming easier. We're seeing, so some of the regulatory, or the shift, for instance, in Alberta, I think they've gone through their third rate reform in Alberta around energy. So some of that instability does make it difficult for clients to sort of look at the whole encompassing, but on the whole, the way we work, it's a standalone. We isolate ourselves from the rates. There's a bit of a risk in there, but we can accommodate for that. But I think our ability to adopt new change and move forward into something new and a new approach, and an all-encompassing approach when it seems too good to be true, that's probably our biggest hurdle that we face.
Awesome. So I've got a few more questions. We've got a couple of minutes left. I really wanted to ask Austen, given your organization's focus on working with First Nations, how are you ensuring First Nations are not only participants in the low-carbon economy, but they actually drive its success?
I think a lot of it comes down to how we start the relationship. We engage very early. We ensure that the GP, LP structures, or the corporate structures that the partnerships are formed in, we make sure that they're true equity partnerships. There's no share class favouring one partner over the other. Typically, the First Nation partners would have the majority interest in the project. So if one First Nation partner had 60% ownership, then of $1 of profit, they'd get 60 cents, and Natural Forces will get the balance. And we've done that from 2014 to 2024 going forward. So yeah, it's very important for us.
Nice. And I suspect that maybe that doesn't sort of register per se on a de-risking perspective, but that's involvement, and that's equity sharing.
Yeah.
They're landowners. Yeah. Land rights. All right. Munich Re. What about insurance for coal plants, tar sands, the like?
Thanks, Jeff. You gave me a nice lob ball there. I think I might have missed your first question. So Munich Re has fully exited from coal and tar sands on the assets and liability side. So we have 2030 targets to have a full exit. So we've been winding down our positions on the insurance and the investment side. So anything up in Fort McMurray, even if it's anywhere attached to the tar sands. If it's a CO2 pipeline that's attached to the tar sands, unfortunately, 100% excluded. We are also winding down our oil and gas positions. I mean, not to 100%, but we do have 2030 and 2050 targets to reduce our exposure on the asset and the liability side to oil and gas assets as well. So thank you, Jeff, for asking that question. Coal and tar sands explicitly excluded.
And Stuart, was there anything that you wanted to chime in with that with regards to what SOFIAC, the projects that they fund, support, build that have anything to do with infrastructure around tar sands or coal plants? Yeah.
Not particularly. I mean, we haven't got any in that area. I'm not saying they'd be excluded, but they probably would. We have from the lenders, the usual no investment in armaments. Casinos are a real problem as well, from gambling and medical marijuana, okay. Normal marijuana, not okay. So we haven't actually had anything. We were trying to look at some of the camps, but it's been slow, so we haven't concentrated on any of that.
Awesome. All right, we are out of time. Please join me in thanking my BFFs up here on the stage. I hope. I hope this was informative. If not, don't tell me.